Welcome back. Let me ask you something straightforward. How much money do you have sitting in your bank account right now? Not your retirement accounts, not investments, just your regular checking or savings account. For a lot of people watching this, that number is somewhere between $3,000 and $10,000, maybe more. And the vast majority of that money is sitting in an account earning somewhere between 0.01% and 0.5% in annual interest, maybe 1% if you're at a slightly better bank. Now let me tell you what inflation is doing to that money in the meantime. At a 3% annual inflation rate, which is close to the historical average, your $5,000 sitting in a standard savings account loses roughly $150 in purchasing power every single year. Not because the number goes down. The number stays exactly the same, $5,000. But what it can buy quietly shrinks. After 5 years, that $5,000 has the real purchasing power of about $4,315 in today's dollars. After 10 years, you're looking at $3,700. You lose nearly a quarter of your money's value in a decade simply by doing nothing. This is not a dramatic financial catastrophe, but it is a slow, invisible, entirely preventable erosion of wealth that affects millions of people who are doing everything else right. They're saving, they're not overspending, they've built a financial cushion. They just haven't taken the next step of putting that money to work. And today, that's exactly what we're going to cover. The FDIC, the National Rates and Rate Caps data, shows that the average interest rate on a standard savings account at U.S. banks as of 2024 is approximately 0.46% APY. At that rate, $5,000 earns $23 per year in interest. Meanwhile, the Federal Reserve's Consumer Price Index data shows that $5,000 in 2019 required approximately $6,100 to purchase the same goods in 2024, a 22% loss of purchasing power in 5 years. The gap between what a standard savings account earns and what inflation costs is not a rounding error. It is a significant compounding annual loss. So the question isn't whether you should move money out of a standard savings account. The question is where it should go. And the answer depends on one thing above all else. What is the money for? Chapter 1. Before we move anything, what should stay in the bank? Let's be clear about something important up front, because this episode is not a blanket recommendation to move everything out of savings. There is a specific, well-defined portion of your money that absolutely should stay in a bank account. Accessible, liquid, boring, and safe. That's your emergency fund. The research on financial resilience is consistent and unambiguous. Liquid savings, money you can access within 24 to 48 hours without penalty, without market risk, without paperwork, is the single most important structural element of a financially stable life. It's what stands between you and high-interest debt when your car breaks down. It's what keeps your investment contributions running when you lose a job. It's the difference between a financial disruption being a manageable inconvenience and a cascading crisis. Research by the J.P. Morgan Chase Institute found that households with a liquid savings buffer of just $2,000 experienced financial shocks, job loss, unexpected expenses, with outcomes comparable to households earning significantly more but with no liquid savings. The liquid buffer, not the income level, was the primary predictor of financial stability through disruptions. A separate study from the Federal Reserve's report on the economic well-being of U.S. households found that 37% of Americans would struggle to cover an unexpected $400 expense from savings alone, a figure that underscores why accessible emergency savings must come before any other financial optimization. How much should stay in your emergency fund? The research-supported range is 3 to 6 months of essential living expenses: rent or mortgage, utilities, food, minimum debt payments, insurance. For someone spending $3,500 per month on essentials, that's $10,500 to $21,000 in a liquid account. For someone spending $2,500, it's $7,500 to $15,000. Where should that emergency fund live? Not in a standard bank savings account earning 0.46%, but in a high-yield savings account at an online bank, Marcus by Goldman Sachs, Ally, Discover, SoFi, or similar. In 2024 and 2025, these accounts have been offering 4 to 5% APY, a yield dramatically better than traditional banks with equal FDIC insurance protection and similar liquidity. Your $5,000 emergency fund earning 4.5% generates $225 per year rather than $23. It doesn't eliminate inflation's impact, but it narrows the gap substantially. First things first, if your $5,000 in the bank is your emergency fund, do not invest it elsewhere. Instead, immediately move it to a high-yield savings account. That single action, which takes about 15 minutes, can increase your annual interest earnings by 10x without adding any risk. Only the portion of your savings above your emergency fund threshold should be redirected to the options we cover next. Chapter 2, the decision framework. What is this money for? Okay, so you have your emergency fund covered in a high-yield savings account, and you have additional money sitting in a standard bank account earning next to nothing. Let's call it $5,000, but this applies equally to $2,000, $15,000, or any amount above what your emergency fund requires. Before we go through the specific options for deploying this money more effectively, I want to give you the single most important question to ask, because the right answer for your $5,000 depends almost entirely on your honest response to it. The question is, when do you need this money? Not in a vague someday sense, in a specific, honest sense. Do you need it within the next 12 months, a known expense like a car repair fund, a wedding, a planned medical procedure? Do you need it in 2 to 5 years, a down payment on a house, a career transition fund, a starting business capital? Or is this genuinely long-term money, retirement savings, wealth building, investment capital with a 10-plus year horizon? The answer to that question determines the optimal destination. Let me walk through each scenario. Chapter 3, the 4 best options, matched to your timeline. High-yield savings account or money market, for money needed within 12 months. If you genuinely need this money within the next year, or if you're honestly not sure when you'll need it, a high-yield savings account, HYSA, or money market account at an online bank is the right home for it. You're not trying to maximize returns on short-term money. You're trying to beat inflation, maintain full liquidity, and not lose anything. An HYSA at 4 to 5% APY accomplishes all three. In 2024, these accounts yield more than most CDs while maintaining daily liquidity. The FDIC insures up to $250,000 per depositor per institution. This is the default safe option for any money with an unclear or short timeline. The practical step here is opening an account at Marcus, Ally, Discover, or SoFi, any reputable online bank. The entire process takes 10 to 15 minutes. Set up a direct transfer from your existing bank and your money starts earning a better return by end of day. This is the lowest effort, highest value financial action available to anyone sitting on cash in a standard savings account right now. Treasury bills or T-bills or I-bonds for money not needed for 3 to 12 months. If you can lock your money up for 3 to 12 months, U.S. Treasury bills, short-duration government-backed securities purchased directly at treasurydirect.gov, have historically offered competitive yields with the highest possible credit quality. T-bills are backed by the full faith and credit of the U.S. government, which is as close to a risk-free investment as exists in the financial system. In 2024, 3-month and 6-month T-bill yields have been in the 5% plus range. Importantly, T-bill interest is exempt from state and local income taxes, which makes them particularly attractive for residents of high-tax states. Series I bonds, also purchased at treasurydirect.gov, offer a different structure, a composite rate that combines a fixed rate with an inflation-adjusted component, updated twice per year by the Treasury. They must be held for at least 12 months and have an annual purchase limit of $10,000 per person. But for money with a genuinely 12-plus month horizon, I-bonds provide guaranteed inflation protection that no other investment vehicle can match in terms of simplicity and government backing. Research from the Federal Reserve Bank of St. Louis on household cash management found that households that actively managed their short-term cash allocations using T-bills and money market instruments rather than standard savings accounts earned an average of 1.8 to 2.4 percentage points more annually on their liquid reserves than those who kept cash in standard accounts. Over 5 years on a $5,000 balance, that differential compounds to approximately $500 to $700 in additional earnings, entirely from moving money between accounts with identical safety profiles. Roth IRA, invested in index funds. Ideal for money with a 5+ year horizon. If this money genuinely has a long time horizon, you are building retirement wealth and won't need it for 5 or more years, the most powerful deployment for most earners below the income eligibility threshold is a Roth IRA. Contributions go in after tax, grow completely tax-free, and can be withdrawn tax-free in retirement. Crucially, Roth IRA contributions, not earnings but the original contributions, can be withdrawn at any time without penalty, which preserves meaningful liquidity in an emergency. For 2024, the Roth IRA contribution limit is $7,000 per year, $8,000 if you're 50 or older. If your $5,000 in the bank is genuinely long-term savings and you haven't already contributed to a Roth IRA this year, moving it there, invested in a low-cost total market index fund or S&P 500 index fund, is likely the highest value move available to you. The combination of tax-free compounding over decades and near zero investment costs at providers like Fidelity or Vanguard makes this one of the most powerful wealth-building vehicles accessible to individual investors. Vanguard's research on the after-tax advantage of Roth accounts estimates that a dollar contributed to a Roth IRA at age 30 is worth approximately 35 to 40% more at age 65 than the same dollar contributed to a taxable brokerage account, due solely to the elimination of ongoing tax drag on dividends, interest, and capital gains over the 35-year compounding period. For a $5,000 contribution, that tax advantage alone, not investment performance, just tax treatment, can represent $1,750 to $2,000 in additional terminal wealth. The practical setup is opening a Roth IRA at Fidelity, Vanguard, or Schwab. All three have zero account minimums, zero commissions, and access to index funds with expense ratios as low as 0.03%. Once open, invest in a total market index fund and set a recurring contribution from your paycheck. The annual contribution limit is per year, per person. Use it or lose it. Trending up, taxable brokerage account in index funds for money above Roth limits or with flexible timelines. If you've already funded your Roth IRA for the year, or if your income exceeds the Roth eligibility threshold, or if you want a medium to long-term investment account with no withdrawal restrictions at all, a taxable brokerage account is the answer. A taxable account at Fidelity, Schwab, or Vanguard gives you access to the same world-class index funds available in a Roth IRA, with the key difference being that dividends and capital gains are taxed annually and at sale. For long-term investors in low-cost index funds, the tax impact is manageable and the liquidity is complete. You can sell and access cash within 2 business days at any time for any reason without penalty. The investment philosophy for a taxable brokerage is identical to the Roth. Low-cost, diversified index funds with long holding periods. The S&P 500 has historically returned approximately 10% annually over long periods. A $5,000 investment in a total market index fund at 8% annual average returns grows to approximately $10,719 in 10 years and $23,305 in 20 years. No active management, no stock picking, no expensive funds required. The S&P Dow Jones SPIVA scorecard consistently finds that over any 15-year period, approximately 88 to 92% of actively managed U.S. equity funds underperform a simple S&P 500 index fund. The implication for your $5,000 is direct. Putting it in a low-cost index fund in a taxable brokerage account at 0.03% expense ratio will, with high probability, outperform any actively managed alternative an advisor or bank might suggest, while costing a fraction as much in annual fees.
Chapter 4. Wait, do you have high-interest debt? Before we close, I need to address something that changes this entire analysis for a large segment of people watching: high-interest debt. Specifically, credit card debt. If you have $5,000 sitting in a standard savings account and you also have $5,000 in credit card debt at 21% interest, you are in a position that defies most investment logic. You are simultaneously earning somewhere around 0.46% on your savings while paying 21% on your debt. The net effect is that you are losing approximately 20.5% per year on the combination, a guaranteed loss rate that no investment strategy can overcome. In this specific scenario, the most financially optimal decision, by a very large margin, is to pay off the credit card debt with the savings. Your effective return on that decision is 21% annually, guaranteed, risk-free, immediate. No investment vehicle offers a 21% guaranteed risk-free return. Not T-bills, not index funds, not anything. Research analyzing optimal financial decision-making sequences for households with both savings and high-interest debt consistently finds that eliminating debt with interest rates above 8 to 10% produces higher after-tax wealth over any comparable period than investing those same dollars at historical equity market returns. The guaranteed return from debt elimination exceeds the expected return from investing once risk, tax drag, and the probabilistic nature of market returns are accounted for. The exception is emergency fund preservation. Maintaining a small liquid buffer, even while paying down debt, reduces the risk of reaccumulating debt during unexpected expenses. The nuanced strategy for someone with both savings and debt: keep enough liquid savings to cover your emergency fund minimum, $1,000 to $2,000, to avoid the cycle of paying down debt and then immediately recharging the card when an unexpected expense hits. Then direct every available additional dollar toward the highest interest debt until it's eliminated. Once the high interest debt is gone, the savings and investment options we covered earlier become the priority. Chapter 5. Your simple decision tree. Let me bring this all together in a simple sequence you can apply to your own situation right now. Not next month, right now. Step 1. Do you have high-interest debt above 8 to 10%? If yes, maintain a minimal emergency buffer of $1,000 to $2,000 in a high-yield savings account earning 4% APY, and direct the rest to debt elimination. Come back to the investment options once the debt is clear. Step 2. Is your emergency fund of 3 to 6 months of essential expenses fully funded and sitting in a high-yield savings account earning 4% plus APY? If no, move your existing savings to a high-yield savings account immediately. Stop here until the emergency fund is complete. Step 3. Is the money genuinely long-term, 5+ year horizon, and are you eligible for a Roth IRA? If yes, open or contribute to a Roth IRA at Fidelity, Vanguard, or Schwab, and invest in a low-cost index fund. Prioritize this before additional brokerage investing. Step 4. Have you captured your full 401k employer match? If no, contribute enough to get the full match before directing additional dollars to a taxable brokerage. Step 5. Remaining money with a flexible or medium-term timeline. Open a taxable brokerage account and invest in a low-cost index fund. Set up automatic monthly contributions so the habit continues beyond the initial deposit. That's it. 5 steps. None of them require financial expertise. All of them have decades of research behind them confirming they produce better outcomes than leaving money idle in a standard savings account. Research analyzing optimal financial decision-making sequences for households with both savings and high-interest debt consistently finds that Americans who had a clear, written financial plan, even a simple, informal one, were significantly more likely to save consistently, invest
invest their savings and avoid high-cost debt compared to those with no plan at all. The research suggested that the primary barrier to better financial decisions is not a lack of information, but a clarity about what to do next. A simple decision framework like the one above removes that barrier. Let me close with the most important number in this entire episode. Not the 4% APY on a high-yield savings account, not the 8% historical equity return, not the 21% credit card rate, though all of those matter. The most important number is this: 0. 0 is what your money earns above inflation in a standard savings account. 0 is the additional wealth generated by inaction. 0 is the return on postponing a 15-minute financial decision that has compounding consequences over months and years. You don't need to be a financial genius to improve on 0. You need to move your emergency fund to a high-yield savings account. You need to put long-term savings into a Roth IRA or brokerage account invested in index funds. You need to eliminate high-interest debt before you optimize anything else. These are not complex decisions. They are available to you right now with tools that are free to access and backed by decades of financial research. The people who build wealth don't do dramatically different things from the people who don't. They do the same basic things, slightly better, slightly earlier, and slightly more consistently. Moving your $5,000 from a 0.46% savings account to a 4.5% high-yield savings account or Roth IRA invested in index funds is exactly the kind of slightly better decision that compounds into significantly different outcomes over 10, 20, and 30 years. Go do it today. Thanks for watching. Share this with someone whose money is sitting in a standard bank account earning nothing. Subscribe for the next one. See you there.